This is the justAlpha Weekly Market Recap. As we wrap up this week, we see a mixed picture across major U.S. equity indices. The S&P 500 closed down 1.63%, while the Nasdaq 100 took a larger hit, falling 3.07%. The Dow Jones fared slightly better, down 1.22%, and the Russell 2000, which tracks small-cap stocks, declined 1.88%. In the bond market, the 10-year Treasury yield nudged up by 2.5 basis points, indicating some cautious optimism among investors. Meanwhile, oil prices saw a modest rise of 2.22%, reflecting ongoing concerns about supply amid geopolitical tensions. Gold, often a safe haven, barely moved, down just 0.04%. The U.S. dollar index slipped by 0.25%, signaling some easing in the dollar's strength. When we look at market breadth this week, we observe a nuanced evolution. Overall, the advance-to-decline ratio improved, moving up by 1 point, indicating that while many stocks struggled, there was still a notable number of gainers in the mix. Specifically, the mega-cap stocks showed mixed participation with an advance-to-decline ratio of 1.18, suggesting that heavyweights like Apple and Microsoft were not as robust, despite 72.9% remaining above their 200-day moving averages. In contrast, large-cap stocks strengthened significantly, boasting a ratio of 3.73, with meaningful improvements in both their long-term and medium-term metrics. Mid-caps also showed signs of resilience, with a similar upward trend. However, small caps lagged, with only 47.4% above their 200-day averages, reflecting a lack of momentum in this segment. Sector performance was particularly telling. The consumer cyclical sector saw a remarkable advance-to-decline ratio of 4.13, signaling strong participation from stocks in this space. Financial services also stood out, with an advance-to-decline ratio of 4.80, suggesting robust performance that may be linked to better-than-expected earnings reports and a favorable interest rate environment. On the flip side, the technology sector faced notable weakness, with a ratio of just 1.27, indicating that tech stocks struggled to maintain momentum amidst ongoing discussions about inflation and potential shifts in Federal Reserve policy. Healthcare stocks found themselves in a challenging position as well, with a ratio below 1, indicating more decliners than advancers. As we connect these breadth trends to recent macroeconomic headlines, we note the ongoing discussions in Washington around a potential government shutdown. This uncertainty has heightened market volatility, with odds of a prolonged shutdown now exceeding 50 days for the first time. Additionally, the inflation narrative remains a focal point, particularly with upcoming consumer price index data expected to provide further clarity on the Fed's next moves. The earnings landscape this week was mixed but showed resilience in certain sectors, particularly energy and materials, where a majority of companies beat earnings expectations. This could suggest that despite broader market pressures, some segments remain fundamentally strong. Turning to cross-asset themes, we see how bonds, gold, oil, and the dollar reflected the prevailing risk tone. The slight uptick in Treasury yields indicates that investors may be pricing in a bit more risk, perhaps anticipating a more aggressive Fed stance if inflation continues to surprise to the upside. Oil's recent gains, meanwhile, hint at persistent concerns around supply, particularly as geopolitical issues loom large. The softening of the dollar could be interpreted as a temporary relief for commodities priced in dollars, potentially supporting further gains in oil in the near term. Looking ahead, one key question emerges. Will the breadth we observed this week, particularly in the financial services and consumer cyclical sectors, be enough to confirm a sustainable market rally, or is this merely a fleeting moment in a broader downtrend? As we navigate these waters, investors will be keenly watching for signals that could either reinforce or challenge the current market narrative. So, as we step into next week, let's keep an eye on how these dynamics evolve, especially in light of the anticipated CPI data and any developments on the government shutdown front.